A good all-round day of trade for Indian markets, more like a bolt out of the blue. Banks and capital goods stocks, they did the trick. Nifty has closed a shade below 6150. Is the strength here to stay? That's the big question on markets tomorrow.
Hi everyone, and of course we will be discussing that and lots more, some of the banking stocks that were in focus. So here's our guest lineup. Prabhat Awasthi, Head of Equity Research and Managing Director, Nomura India, joins in on the show. There's Pankaj Pandey, Head of Research at ICICIdirect.com. And Sandeep Wagle, Founder and Managing Director at Aptar Technical Advisory Services, to run us through the charts. Well, let's start off with you then, Pankaj, and get in your sense of where you see the markets headed from these levels and whether or not you think the conviction from the bulls is now here to stay.
I think if you really look at from a forward number perspective, we are trading at about 15 times. Recent quarter which concluded, if you actually exclude Tata Motor numbers and CISA Sterlite is not comparable and exclude the oil and gas component from the Sensex, the bottom line growth again would come in single digits. So it's a kind of a polarized market, and I think if you look at the defensives continue to do well, the earning growth there is intact, and which is where the valuations are also quite rich. So there is no easy money to be made. So from that perspective, we don't expect a big jump in earnings, and as a result of which we would not expect a big directional move in the markets. I think at best what can happen is that we have been trading in a range of 100 to 200 points. That range might get slightly get bigger, but beyond that we wouldn't expect much of a big directional move going forward.
Sandeep, you've been maintaining a view that this market is not going anywhere. Both the signposts are clearly well defined. It could be 60-200 on the upside, it could be 59-50 on the downside, but we will not go anywhere. So do you want to take that thought forward? Looks like we are approaching now the upper end of the range.
Nikunj, I couldn't agree more with what you said. I think summed it up absolutely. I would agree with you point to point. I don't see 62.50, 62.80 being broken, so obviously the bulls don't seem to be in control. At the same time, the bears don't have that strength to push the Nifty down below 59.50, and in fact now I think 60.50 could also hold. So 60.50, 62.50, that 200-220 points range is where I see the Nifty moving in. And one can talk of a bull market or a very clear up move and the bulls being in control only if 6400 is clearly taken out with force and we move beyond 6600, 6700. Even if this 6400 is taken out, we may move up 50 points and again come back within that range. So that doesn't talk of any great singular move. So in that sense, I would say consolidation is on and more stock specific moves to follow. The market is neither in the group in bull grip, neither in bear grip. I think that is a better way to put it.
Okay, neither with the bulls or the bears, but Prabhat, let's get in your view because, we want to find out what exactly is holding the index back. No doubt it was a stellar move today, but some of the other stocks are showing a very strong direction, but the Nifty per se seems to be rather range bound, caught in a narrow band. What exactly do you think we can attribute this to?
Which I think is again to be expected. One, there is nothing happening globally, I guess. There have been some concerns which came up because of the growth slowdown we saw in some of the economic numbers. Apart from that, I think the fact is that Indian domestic market is waiting for the election results now, and there is, I think, still a degree of apprehension with regard to elections as to which way they'll pan out, even though there have been opinion polls, but we have seen that the volatility around election of markets has been extremely high in the last two elections. So as a result, basically we are essentially seeing investors not being active, very active, because if you look at the market volumes, they have really come off quite a bit. So now why the market is not, so that's why market is not doing much. Now, you must remember that, there have been, market is at 21,000, it's done reasonably okay, given the fact that we had massive apprehensions about the state of the economy. Even 6-8 months ago, rupee was depreciating, so I think we stabilized quite well, we have come off the bottom quite well. And the fact is that, there have been stocks which are mostly related to global economy, which have done exceedingly well last year, which have reflected their fundamentals fundamental shift in their outlook, like IT, for example. So I think to expect a market to move dramatically before elections from here, when there are not those many triggers in place, I think it's too much to ask. So frankly, market probably will remain range bound even going forward.
But a pack that was noticeably quiet in today's session, didn't really contribute on the upside, was the IT basket. And Prabhat, the question is, do you think that IT will do well irrespective of the election risk, or is IT more like a safe haven, buy into IT before election, and post-elections the markets will come down and IT as a pack is not going to be spared?
It was very tough to say, timing-wise, frankly, and frankly, again, usually when you try to time it, it's usually the thought process in the price, because the market is smart enough to figure it out. IT, I think, for us has been a secular sort of story because of a very simple reason that there will be the volume growth is stronger. The end markets are doing well, so the fact is that we have seen clearly, guidances have gone up. The numbers which have come through in the 1 or 2 quarters, not only because of rupee, but also because of the fact that the end demand is picking up, are clearly good. Now going into elections is trickier because if you have an outcome which market really likes and there is a lot of money which pours into India, then rupee could appreciate, and in the very short term you could have a situation when IT doesn't perform. But our call on IT is underpinned more by a fundamental demand drive, demand which essentially has picked up. So it could well be the case that you have a couple of months when IT underperforms or outperforms, as the case might be dependent on election results. But fundamentally our case is that this sector is not as expensive as it used to be when the demand conditions were good. So its valuations are not excessive. The demand cycle is picking up. Europe is starting to improve from the bottom. US is doing well. Therefore, IT is a sector which you should hold on to. Tactically, obviously, after elections, there could be volatility in sector performance.
Sandeep Bagle, it was a day off for HCL Tech and other IT, large names. But Tata Elxsi, Hexaware, mid-cap IT stocks were clearly in demand. So do you think the swing factor now is more favorable for mid-cap IT than large-cap IT, at least in the short term, at least for the moment?
Absolutely. If you go by the pattern, the volumes and the price and the volumes breakout that normally in technicals we look at, I would go with a very clear Hexaware. I don't see that much strength in a HCL Tech or a TCS, not to say that they are weak, but very clearly I think the mid-cap, some of the stocks in the mid-cap space, let me put it that way, would clearly outperform.
What is it that you would be doing then, Pankaj, when it comes to the overall metals basket? No doubt we have seen quite a bit of news impacting the sector, but would you be staying into it, or do you believe that the fundamentals are a little weak and you'd avoid the basket?
I think overall, if you look at, we are not expecting big set of improvement on the overall performance of the company. So, for example, for a company like SAIL, we would expect EBITDA per ton to be in the range of 4,000 to 5,000, which is not a very great number from that perspective. And the stock is trading, say, for example, at over 5 times EV by EBITDA. And so, similarly, the case with Tata Steel or a number of other frontline stocks. So, wherein we are not expecting that kind of a jump in profit numbers, and the debt levels are still quite high. So from that perspective, we don't expect this sector to do well, and largely we have been negative on this entire sector, and with sales like SAIL, wherein we have a target price of about 53.
As promised, we'll be flagging off some of the top bets to watch out for in terms of individual stocks. We'll start off by getting a sense of what the dealing rooms are advising. Darshan's here from our research desk. Darshan, what have you been picking up?
See, Avan, L&T is something that dealers are recommending. What they have indicated, some of these institutional dealers, is that domestic mutual funds were buyers in today's trade. And today, the entire capital goods space rallied post ABB coming out with numbers, and they believe that the momentum in the capital goods space will continue. Technically, also L&T looks strong. So L&T in all fronts looks good to them at this point of time. The other pack that did extremely well today was the mid-cap IT space, and NIIT Tech was one of the counters that did well apart from Polaris. Dealers are recommending to buy this counter on a positional trend. They expect some kind of corporate development to be announced very, very soon on the company.
Darshan, thanks a lot for that. Pankaj, what are your top ideas? How are you allocating capital? Give me one idea from the mid and the small cap space.
So within the mid and the small cap space, we like some of the names like Oberoi Realty, we like Shree Cement. Largely from the perspective that, say for example, Shree Cement would benefit from the fact that they are expanding their capacity from 13.5 million tons to about 21.5 million tons. Although volume growth would be good, but probably pricing might be under pressure. But on a relative basis, since they have a stronger balance sheet, we would expect them to sort of do better numbers compared to the overall industry. So which is why we like this stock. We like Oberoi for the fact that the volume growth would pick up because of the launches which will happen on the Worli project and also the recently approved Mulund project. So we'll get a better visibility on those numbers. And the company is again debt free, and we believe that going forward you will see a better numbers, and which is why we have a target price of over 285 on the stock.
What about you, Sandeep? What have you spotted on the charts?
I wanna buy in Arvind, stop loss of 141, target 153. Buy in Z Entertainment, stop loss of 262, target 277.
Prabhat, closing comments from you. What is your take on banks? Do you think the pain is here to stay, or banks now are looking quite attractive because everyone is bearish on them, and the margins and the valuations also looking quite attractive?
Well, the pain definitely is here for some more time, and that is largely because of the fact that we have a very slow economy. We still have residual impacts of the policy logjam in sectors like power and roads, which are still where the plants are still getting commissioned, and that pain is still coming through in terms of restructuring or NPAs. So that pain is not going to go away, I guess, in the very short term because of these issues. But I think on the other hand, clearly you started seeing some amount of positive surprises on the inflation data, which should ultimately augur, and given the slowdown in the economy, should augur that interest rates will start to peak out sometime. So there are two opposing forces which are working on the banks. Now banks got beaten down a lot because of the fact that the RBI raised rates when it was least expected to. So the fact is the banks actually started underperforming post that event. And therefore, I personally think that there is a lot of pain which is already built into the stock prices. You know, you can't continue to penalize them on the same issues again and again. So long as you are reasonably convinced that there is, the books of banks will not get impaired to an extent that is being implied by the market. For example, PSU banks are trading at a big discount to price to book. So market is saying that their books will be impaired. I think the truth might. So I mean, we are reasonably clear that private banks will be able to get out of this unscathed. So we are more positive in private banks. But even within public sector banks, there are banks which probably do not make the cut, but there are banks which are looking interesting from the fact that valuation perspective.